As usual, we'll start with the balance sheet. In the year 2020, we've seen our investment in government securities growing by 23%, and that talks to the positive liquidity that we had in the year. When I talk about deposits, you will see that. We also invested in our net loans and advances, that growing by 11%, closing at about 595 billion. Deposits grew by 12% to 767 billion. That was invested in the loans and in the government securities that I've just talked about above. So total assets grew 10% in a year where the operating environment was a bit difficult. Part of this growth came out of the assistance we gave to our customers in terms of giving them moratoriums, capitalization of part of their interest that went into the growth you're seeing in the loans and advances, and the bulk of it then was invested. Any excess liquidity was invested in government securities. I think this slide just shows that the fundamentals of the business are still positive. They still bring in resilience in how the balance sheet of the bank operates. Looking at how the loans have been distributed, the growth of gross loans of 14% over the year, the bulk of that came out of retail, which is our check of preposition, which is the largest sector within our book. Earlier on in the year 2020 Q1, we did have a good growth in corporate as well, coming out of the manufacturing sector and our mortgage business. Comparing how our sectorial book looks against the market, the industry, you can see they sort of mirror each other. We have a large market share in personal household and real estate, but in terms of just how it compares to the industry, it's fairly well aligned. Coming to asset quality, not a very good performance here. 14.7% NPL. That's where we closed in 2020, the highest we've been in a very long time. We saw sectors like tourism, restaurants, hotels, manufacturing sector quite hit by the COVID-19 in 2020. That necessitated us to downgrade a number of our accounts. Some of them that we would have otherwise been able to restructure, but under the environment that we found ourselves in, we saw a net growth of our NPL stock going up to 96.6 billion, which is about a 33% increase. If you look at the various divisions within our business, check of mortgage, corporate and SME, you realize that the bulk of this NPL, non-performing loans, are actually coming out of corporate, and which is not too surprising. We saw a bit of an increase on mortgage as well, given the performance in the market on real estate. I think that was to be expected. The CEO did talk about the restructuring and the support we gave our customers. So 20% of our total book was restructured, what we called COVID-19 restructures, amounting to about 106 billion. That distribution is demonstrated there in terms of from each of the sectors. The real estate being top at about 27.6 billion, and the bulk of these real estate restructures we believe will actually get out of the restructuring bucket and get back to operating business as usual. The tourism and hospitality and hotels is an area where we believe we need to take a longer term view in terms of when those will recover into 2021. So that's something that we have our eyes on from an outlook of 2021 point of view. In terms of industry, almost 50% of the book in the industry was restructured. KCB is operating marginally below, well, maybe not marginally, but below. And this is a view that we will have to see in 2021. Looking at our deposit, our deposit base continues to be fairly stable. It's CASA-driven, corporate demand, savings. That, in fact, the proportion of that did increase in 2021 from 62 to 67%. The term deposit held at 21%, and in terms of how that has been distributed, you can see corporates and SMEs taking about a third of that, individuals at 23, and government comes in at about 45% of the term deposits. This is the ones that we pay for, just to ensure that our deposit mix and the amount of liquidity we have in the market is, rather in the balance sheet, it supports our lending activities. Looking at capital, our capital buffers are well above what the regulator requires. And in 2020, we even went further on and optimized our capital structure. We brought in debt, about $150 million of Tier 2 debt, to give us a leverage of about 26% in our balance sheet. And that allows us to be able to take decisions in terms of investment, to be able to take decisions in terms of dividends to our shareholders, because it does give us the flexibility with a well-optimized structure of capital. Coming to the P&L, starting with the net interest income, we saw a growth of 21%. This was largely volume driven. I talked about the growth in our loans and advances earlier, 11% increase. Despite a continued reduction in yield in the year, as you saw from the macro presentation, the CBR rate in most of the countries we operate in was on the downward trend, and that was because the regulator wanted to obviously spur economic activity by reducing the lending cost of lending, which brings in money into circulation in the economy, and as a consequence gets the economy going. That notwithstanding, the volume growth offset the reduction in yield and brought in a 67.9 billion net interest income, a 21% growth. At a non-funded interest income level, that remained flat, and it's a mixed bag in terms of the drivers. Commissions and fees declined in the year, and that's largely out of two main reasons. One, the reduction in disbursements that to our digital mobile loan product, which was a conscious decision just to protect the bank in the environment we were in. And the second one was support to our customers by way removing fees for money transfer, mobile money transfer, the waived fees for transactions that are below 1,000 shillings. So that has had a big impact in terms of our revenues at fees and commissions. FX had a fairly good year, a good growth in 2020, and as did other income. Included in other income is the trading income we make out of investing in government securities, and a risk margin element from self-insurance that we do for our check-off loan facilities. Expenses, we saw a 12% increase overall on operating expenses to close at 43.2. But the bulk of that is because of the annualized impact of consolidation of the National Bank of Kenya, which is a subsidiary that we acquired at the tail end of 2019. If you do a like-for-like comparison, the operating expenses in 2020 actually came down by 3%. We did, when we looked at our forecast for 2020 at the onset of COVID realization, one of the pillars we targeted in terms of delivering performance for 2020 was cost management, and we managed to take out close to 5.3 billion in cost savings out of our P&L, and that delivered the operating expense line. Right, moving on to just to look at the big growth on loan loss provision, which is the area that has really impacted our performance in 2020. 205% increase in provisions from just under 9 billion to 27 billion. And that was directly driven by COVID issues and to some extent impacted by nudged by the macros that the environment brought. So in terms of stage 1 to 2 and migration to stage 3, you can see a massive increase of 12.4 billion of our facilities moving into stage 3. And then the COVID overlays, which is just looking at our entire loan book and looking, understanding what future information, how the market outlook will be, and taking a prudent view in terms of taking early provisions for some of the sectors that we believe will take a longer time to recover. So at PAT level, profit after tax, we closed the year at 19.6 billion. This represents a decline of 22% from previous year, and the driving factors of this performance, I think I've already mentioned them in the previous slides. At subsidiary level, all our subsidiaries delivered a profit, which is definitely a positive thing. At PBT level, 3.6 billion delivered from subsidiaries. It represents about a 15% on total delivery, which is a growth from 11% that we saw in 2019. All the key indicators, from cost to income, loan to deposits, non-funded income, were on the positive trend. And this sort of is momentum that we intend to build on as we move into 2021 to ensure that our subsidiaries deliver the 25% we are looking for in investing in our regional businesses. Overall, putting everything together, the balance sheet, healthy growth of 10%. Maybe I'll pull out just one item under the liabilities, long-term debt. You can see the growth of 70%. That's the additional capital of 150 million dollars that we brought into the book, and shareholder equity growing by 10%, and that's largely out of the profitability that the business delivered. At P&L level, I think this is the consolidated view. The key item there, when you look at it holistically, is the provision for bad debts, the big increase that I talked about separately earlier. I think maybe it wouldn't do justice without touching on tax. We had a very good effective tax rate in 2020. Our effective tax rate was 22, which is 3 percentage points below the corporate tax rate in Kenya, which was 25. And I talk about Kenya because it is the largest subsidiary, and that is largely out of the tax efficiencies we saw from managing our tax, the deferred tax assets that we were able to amortize into 2020. So looking at the full KPIs, and I will not get into the detail of all this. I think the one that really sticks out there is cost of risk. At 4.6 in 2020, our cost of risk has always operated at about below 2%. I think this is an area that we will continue putting focus in 2021. We understand why it went up to 4.6 for at group level, and with the restructured facilities that will come into 2021, rather spill over into 2021. It is an area where obviously we will have our full head beams on to ensure that we don't get to that level of cost of risk.